Gold just hit a new all-time high of $36.70 an ounce, and already some analysts are calling the top. But the numbers say the opposite. This is the fastest move in gold's history, and it's exposing a truth Wall Street would rather you ignore. Price targets are climbing, and the upside moves aren't slowing down, reinforcing a belief that many in our community have held close for months. Despite the massive moves in gold, this might be closer to the beginning than the end. If you're the type of person who values unique takes and valuable insights on precious metals without the hype, you've found the right channel. Subscribing is a small but meaningful way to support the channel and ensure we can continue to bring you fresh content each week. Thank you. It's not surprising some doubt gold's rise. We've seen this story before. Asset bubbles form, expand, and then collapse. Gold's sudden surge is unusual for what's usually a slow-moving, stable asset. And history gives skeptics plenty of ammo. In 2011, gold rocketed to nearly $2,000 an ounce, only to crash back down and grind through a decade-long bear market. But the gold market of today looks very different from 2011. Back then, the London OTC market and COMEX futures were the dominant players, and futures trading had outsized influence on price. Today, the market is far more decentralized. Physical demand from India and China carries more weight. Central banks have flipped from being steady sellers to some of the largest buyers, creating deeper, more liquid markets and supporting higher price floors. And supply is more diverse now too, with significant new production coming out of Africa, Asia, and South America. The result is a structurally deeper, stronger market with more participants and robust demand. We aren't seeing rising demand from one centralized location that would indicate a bubble. We're seeing steady growth and investment from a wide number of market participants. And in a somewhat paradoxical sense, demand for gold appears to be growing in the face of rising spot prices, opposite of what you'd expect from classic supply and demand fundamentals. Research from the World Gold Council backs this up. In markets with weak liquidity, prices swing wildly because a single large trade can push the whole market around. Thinly traded assets rarely make it to new highs. But gold today is opposite. Liquidity is deeper, and it makes the current rally much more durable. In fact, trading volumes in gold are rising right alongside prices. Normally when prices go up, demand cools off, but not this time. Daily trading volumes in 2024 averaged about $232 billion a day. This year, through August, that number has surged to an estimated $319 billion a day. And it's not just one market driving it, it's across ETFs, exchanges, and the big over-the-counter hubs like London and Shanghai. Put simply, more people are pouring more money into gold, even at record prices. The reasons for all this aren't complicated. The world is running out of safe havens and running out of trust. At the center of it is the US dollar. More and more, the world sees what Washington won't admit. The only way the US can service its massive debt is through debasement. That means every dollar gets weaker over time, and countries are catching on, diversifying away from the dollar and into gold. There are a couple of ways the US can weaken its own currency. The most obvious is quantitative easing, what most people call money printing. Decades ago, that meant running the presses. Today, it's just a few keystrokes at the Fed, creating digital dollars out of thin air and flooding the system with new credit. The other way is issuing massive amounts of government debt, and that's become America's favorite tool. Every new wave of debt brings foreign dollars into the system, expanding supply and quietly debasing the currency. Inflation works like a hidden tax, the kind most people never notice. Take a simple example. Let's say you buy a pair of shoes for $90 and a 7% sales tax. That tax costs you $6.30. But if inflation pushes the price of those shoes up to $100, the tax jumps to $7. The rate didn't change. Your tax bill went up anyway. That's how inflation quietly raises taxes without you realizing it. This is how America will cover its debt, through inflation and debasement. There's virtually no other path. Earlier this year, even business leaders like Ray Dalio warned Washington to get its deficits under control. A 3% deficit target was floated, and Congress recklessly brushed it off without a second thought. Instead, we're running deficits more than twice that. Just more proof that fiscal discipline is off the table. The pivot to gold makes perfect sense once you look at the macro backdrop. Developed market central banks already hold nearly half their reserves in gold, about 47% on average, so their buying has slowed. But emerging market central banks are a different story. They're still underweight gold, and the top 20 alone would need to buy around 24,000 tons just to catch up with their developed peers. To put that in perspective, the world only mines about 3,400 tons a year. That means we have a group of price-insensitive buyers who will be supporting gold for years to come. Analysts are starting to understand that traditional forecasting methods have underbid gold's performance because it hasn't been able to adequately predict the changing balances of risk and how that would affect gold's performance. Traditionally, gold returns about 8% each year on average. Last year, returns were over 20%. This year, it's approaching 40%. On the charts, gold's rise looks almost exponential, and usually the kind of move signals a crash is coming. But this time, the market isn't flashing exhaustion. The structural drivers are still firmly in place, which means what looks like the end of a rally could actually be the start of something much bigger. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.